Hello, this is Mike Wade, Chief Options Strategist for Tom Gentile, and welcome to this video featuring Tom's Tools. In this video, I'm going to talk to you about how you can profit with the sunrise. Yes, what I'm talking about is putting on positions that benefit as the sun rises each and every day. So let's start by taking a look at the three ways that you can use options to profit. Options are very sophisticated instruments. They have time value. They have real value. They're impacted by the passage of time. They're impacted by fluctuations in implied volatility or the expense of the options. And as you become more advanced as an options trader, you actually derive a three-part prognosis, picking direction. Do you think the stock's going to go up? Do you think the stock's going to drop? Do you think the stock's going to go sideways? And as we talked about in my last video about the honey badger, implied volatility or the expense of the options fluctuates as well. So as part of your three-part prognosis, do you think the implied volatility is going to rise during the life of your trade? Is it going to drop during the life of your trade? Is it going to go sideways or stay the same during the life of your trade? And lastly, options have time value in them, and when you buy an option, you're actually buying time value. And that time value will decay over time as you approach expiration, and the amount of decay actually accelerates into expiration. So we can predict direction, but really not with 100% accuracy. We can also predict implied volatility with very good accuracy, actually better than directional accuracy for the most part. And lastly, with time decay, we can predict that with 100% accuracy because we know that tomorrow is going to happen, and if it doesn't, who cares about our trade anyway? So now what's important to note is that we can actually measure our position sensitivity to direction, implied volatility, and time decay using something called the Greeks. When most people hear the word the Greeks, they think, oh my gosh, that's complicated. But it really isn't. The Greeks are nothing more than sensitivities, or your position sensitivity to directional movement, to implied volatility fluctuation, and to the passage of time. And we actually have Greek symbols that match up with direction, IV, and time decay. Delta measures your position's sensitivity to direction. Vega measures your position's sensitivity to IV fluctuations. And Theta measures your position's sensitivity to the passage of time. Delta, Vega, Theta. That's it. They're just measuring sensitivity. Similar to a dashboard on your car, these are measuring the effect of outside forces on your option position. So let's take a look at an example. Let's assume that we're going to buy one call option. We're going to buy one Citigroup August 21 51 call for $1. All right, so what does this call option do? It gives us the right to buy Citigroup at $51 between now and August the 21st, 2020. One option contract controls 100 shares of stock. This price is per share of stock controlled, so the total cost for this position will be $100. And that $100 for this long call right to buy Citigroup is also our maximum risk in the trade. So the worst case thing that happens is that the stock tanks or the stock stays the same and your call option goes to zero. The most you can lose on this trade per contract is $100. Now let's take a look at the Greeks. Now this is your dashboard for your option position. Now remember, the delta is going to tell you your position sensitivity to directional movement. So this first one, positive 59.74, it's an implicit positive, is telling me that if the stock goes up by $1, then I'll make $59.74 on this position. That's pretty good. If the stock goes up $1, I'm going to end up with $59.74. That's over a 50% increase in the originating value of the position. I'm going to skip gamma for now. I'll touch on it just a little bit, but it's really not important for this discussion. So I'll come back to that in just a sec. Vega measures your position sensitivity to fluctuations in implied volatility or the expense of the options. In this case, we have a implicit positive 2.08. What does that say? That says that if implied volatility were to go up by 1 percentage point, we'd make $2.08 just on implied volatility rush. Now what's Theta telling me? Theta's telling me what's the impact on my position's value with the passage of 1 day of time. And notice here it's a negative number, negative 8.92. That means that tomorrow this position will lose $8.92. So what's important to note is that there's primarily three things going on that are affecting the value of your option position. The stock's moving around. Delta is going to come to bear and impact the value of our position. Implied volatility will likely be moving around, and Vega is going to tell us what the impact of IV fluctuation is doing to the position, and then Theta as well. So you're going to be making or losing money in 3 different places during the life of your trade. You add up the impact of Delta, the impact of Vega, the impact of Theta, and that's going to be the impact on your position's value for that given time period. Now, Gamma I'm not going to talk too much about, but Gamma tells you what your new delta will be with a $1 movement in the stock. Another way to think of it is the delta of the delta. Delta changes with the stock price movement. Now, let's take the other side of the trade. Remember, if you're buying a long call, somebody on the other side has to create or write the long call and go short. So these are the Greeks for a short call. We're going to sell one of the Citigroup August 21, 51 calls for $1. Exactly the same price, exactly the same option as we did when we bought it. If a long call has the right to buy the stock, if you sell the 51 call, then you have the obligation to sell the stock at 51. By selling a 51 call for $1, we end up with $1 credit. That's the most we can make on this position. We take $1 in, and our hopes are that the whole thing expires worthless by the time expiration comes along on August the 21st. Now, where a long call has positive delta, a short call has negative delta. So this negative 59.05 says if the stock were to drop, the negative implying a drop, if the stock were to drop by $1, I'd make $59.05. On Vega, if the IV was to drop by 1 percentage point, we would make $2.09. Again, the minus sign is telling us that if the IV drops, that's good for us. Now, here's the good part. This is how we're going to make money with the sunrise. My Theta in this case is 9.06. What does that mean? That means by tomorrow, 24 hours from today, Theta will add $9.06 to the position's value. Now, of course, Theta and Vega are also contributing to the position's value. We're not going to be necessarily generating $9 of profit. Theta is day by day contributing value to our position. And the icing on the cake is Theta gets more positive for a short call as we approach expiration. So it just gets better and better as we go along. Now let's compare the two, because I just really want to emphasize the inverse nature of the Greeks when you go long, which is the top box here, and then short the bottom. So notice our delta on the long was 59.74, and then on the short is just the opposite, negative 59.05. Vega was positive 2.08 on the long call, and then on the short call it was negative 2.09. The numbers are going to be slightly different, but the magnitude's the same. Theta on the long call was negative $8.92, and then on the short call was a positive $9.06. So the signs of the Greeks will flip around. Notice gamma is also the inverse as well. So the signs of the Greeks will flip around depending upon whether you're buying or selling. So let's break it down further. Let's make sure you really get this. Theta is allowing us, positive theta is allowing us to make money as the sun rises. This is the part of options trading. When you short options, your theta is going to go positive, and you know you have a time decay edge because you know tomorrow is going to happen. You don't know if implied volatility is necessarily going to drop in this case. You don't know necessarily that the stock's going to drop in this case. You just don't know that for sure, but you know for sure Theta will be contributing value to our position each and every day, and that number gets more positive as we go along. Now, here's the other edge that's not necessarily obvious, but here's the thing. The position would prefer that the stock drop by as many dollars as possible, and with every dollar, we're making about 59 bucks. But here's the other thing. If the stock doesn't go anywhere, if it goes sideways, we're not going to make any money on delta, but we're going to be making money on theta. So a short call makes money if the stock drops or if the stock goes sideways. Given there's three potential directions the stock could go, up, down, sideways, you take two of them, that's a 67% statistical probability of profit just by selling an option. It can be a call option or it could be a put option. Now, as good as that is, it's really important to note that doesn't come without a cost. There is maximum risk when you short an option. Sometimes short options are called naked options because there's no protection. So what we have to do is to protect ourselves. We need to get rid of this max risk. We still want our positive theta, but we want to get our max risk down to a manageable level, a contained level. And we can do that in a number of ways. We're going to talk now about theta positive strategies. These are strategies that allow us to profit with the sunrise and do so with protection. So there's lots of different strategies. The main ones that you've heard about are iron condors. I spoke about iron condors in my last video with the honey badger. We also have credit spreads. Credit spreads are really great. These are multi-directional strategies, 66% chance of profit on these credit spreads if you place them out of the money. And then you have butterflies, which are similar to iron condors, except they share the same short strike. So those are other advanced strategies. I've talked about butterflies before as well. I'll probably do a credit spread video in the upcoming weeks here. But the one I want to talk to you about in this video is calendar spreads, because calendar spreads, pound for pound, offer, in my estimation, the best reward to risk profile. They're high probability, and they come with one of the lowest risk profiles of all theta positive strategies. Let's start with an example on Citigroup. This was a trade that I published back in July, and I want to share it with you. So first off, when you put on a calendar spread, as you'll see shortly, the first step is to find stocks that you think are going to be in a range. And so you can see here on Citigroup, we actually entered this trade on 720, which is the right side of the graph here. And you can see here that over the last 6 weeks, the stock pretty much has been living between 54, which is this upper line, and 48, this lower line. And earnings just happened that the earnings were bad. The stock got a little bit of a spanking and then popped back up and started moving sideways. There was even some support at 50. So bottom line is we expected the stock to stay in a range. So with that prognosis, the next thing to do is to create a calendar spread. So what we're going to do in this case is we're going to use put options, and we are going to sell 10 August 7 51 puts for $2.65. That's, again, this is on Citigroup. And we're going to protect ourselves by buying 10 of the August 21 51 puts for $3.15. Now, it's important to note that you have rights and obligations. When you buy a 51 put, that gives you the right to sell, in this case, Citigroup, at $51. Now, what does the short option do? This is where we're going to make our money. This is where our positive theta comes from. So when you sell short 51 puts, that gives you the obligation to buy the stock from another at 51. So had you just shorted the option and the stock went from 51 to 20, you would be obligated to buy that stock for 51, even though it might be worth 20. So that would be called a naked put, and you would be exposed to the downside. So what we do to protect ourselves is to buy a longer term option and give ourselves the right to do to another as they could do to us. So we buy the right to sell Citigroup at 51. In the event the stock tanks, we might get assigned the stock at 51, and then we turn around and sell it at exactly the same price. So therefore, the net debit on this calendar spread is our maximum risk. When you buy something for $3.15 and you sell something for $2.65, that's a $50 net debit. If you do 10 of them, that's going to be a $500 net debit. And that net debit is exactly the same as your maximum risk. So there you have it. We've actually contained our maximum risk by using a calendar spread. If all goes exactly right, then this spread will give us a 256% return on investment, just over actually. That's really good. And here's the best part. This is how we're making money with the sunrise. We're going to generate $18 a day in theta, and that number will get more positive as we go towards expiration. Let's take a look at a picture of the trade. We're going to call this picture a risk graph. This is a risk graph for a calendar spread. It looks kind of like a witch's hat flipped over on its side. And what the risk graph does is it takes stock price, here's the stock chart over to the left, it takes stock price and translates whether you're making money or not in your option position. So the combination of the long and short puts at 51 produce this risk graph. This risk graph expires in 18 days. It represents the amount of time left in the short option only. So on the right side of this vertical line is profit. So the profit in this trade actually lives in the cone of the witch's hat. Also, you can see these break-evens on the upside and the downside showing us our profit zone. So provided the stock is in this green zone or backyard for the next 18 days, we're going to make some kind of money on this trade. And the really good news on this trade is we're expecting the stock to stay between 54 and 48. These two dotted blue lines, we're expecting the stock to stay in this range, whereas we have profit in a bigger range. So this is an exceptional calendar spread. And the way it makes money is time decay. It makes money on theta. This area here, these colored lines, will collapse into profit as we approach expiration. Maximum profit is right here at the tip of the witch's hat, which is just shy of $1,300. Now, let's see how this trade actually progressed. I'm going to point out to you that these colored lines will start to collapse day by day as we move through the 18 days of life in this trade. So let's take a look at that. I'm going to zoom back in. Keep your eyes up here on the red text, 18 days. That will always be the current day. So right here, this red line represents the profit or loss in the trade today, always today. The blue line is 1/3 of the time gone, the green 2/3 of the time gone, and the black expiration. The amount of profit or loss in the trade is always going to be the intersection of this blue line, which is the stock price, and the red theta line. So I'm going to advance this forward one day at a time, and let's watch what happens. Time is ticking away. With every passage of time, notice how the stock is moving a little bit, but what's really moving is time is working for us. The sun rises, these colored lines move this way. The sun rises, the sun rises, the sun rises. The stock is performing well. It's staying in the range we thought it would stay in. It's certainly well within the break-evens. It's behaving itself. Let's go forward another day. Right now, there's 10 days left in the trade. Things are working out very well. The dog is staying in the backyard. Colored lines are collapsing into profit. And then we get a big move up in the stock. But still, with 9 days to go, we still have about $200 of profit in the trade. Take the intersection of the red and the blue line and right around $200 or so in the trade. One more day, the stock drops back into the middle of the range again. There's our profit. It's getting bigger and bigger. The stock drops, 7 days to go. Still, we're at almost $400 of profit at this stage. Stock rises a little bit. 4 days to go, 3 days to go, 2 days to go. This is the Wednesday before expiration. 2 more trading days to go. And the stock is smack dab in the middle, right at $51.04, which is right where we're at here. Now, I could continue to wait on this trade, but the issue we have is as we get closer to expiration, is that a dollar move in either direction can greatly diminish profit. So one of the rules that we have is we want to get out of our trades with 2 days to go before expiration, which is what we did in this trade. And you can see here that we made $500 of profit on $500 of risk. That ended up being a 100% profit on this trade. So as you can see here, this is a demonstration of the power of time decay, theta, profiting on the passage of time, profiting on every sunrise during the life of the trade. So calendar spread entry rules are quite simple. You want to find range-bound stocks. Make sure your break-evens for your calendar spread encompass the range of the stock. You sell 14 to 21 day at-the-money puts. You buy 30 to 45 day at-the-money puts. Make sure it's the same strike, of course, and then give yourself at least a chance to make 100% potential return on investment. So as I said earlier, you've got to have risk graphs in order to trade calendar spreads. You're flying blind otherwise, so be sure you're using a risk graph tool. Of course, I use Tom's tools. They are, in my estimation, the best around. All right, let's talk about the exit rules because this is really the important part, the most important part. And we'll start with the loss exit. So really, you can't lose money as long as the stock is in the backyard between the break-evens. So really, the exit rules for losses are really simple. If the stock jumps outside of the profit zone, in this case to the downside, you get out. Now, provided the stock doesn't gap, and usually you're going to get a decent move maybe beyond the break-even, but here's the best news about using break-evens as your exits. If you get out, let's say we get out here, which is even beyond the break-even, you're really only risking in the trade $100 or so on the trade. So that's a 20% loss to the downside. Same thing for the upside. If the stock jumps up above the upper break-even and closes there, you want to get out as well. Now, in this case, if you got out right in this area here, today the stock's up here, we get out here, we're only losing, again, about $100 on a $500 trade in this case, and that is only a 20% loss. So that's the very best thing about calendars. When you're wrong and you get out, at these break-even levels, then your risk is going to be very small compared to your profits on average. Lose a little bit when you're wrong and make a lot when you're right, and you're going to be right much more often than you're wrong on these calendar spreads if you follow these rules. The first profit exit is to get out 2 days before expiration, which is what we did in the example. The reason again for that is that once you get into the witch's hat, the tip of the witch's hat, a small move in either direction can greatly diminish your profit in the trade. You can lose profits, in other words. So get out with 2 days before expiration, or if you're able to capture 50% of your maximum return on investment potential, in this case 256.43%, when you can get half of that, you want to take your position off. So in this case, if I was able to get 128% profit on this trade, I would take it off and be very happy about it, because that's a nice return for 18 days, actually 16 days in this trade. So in summary, here are your exit rules for calendar spreads. If the stock closes outside of the break-evens, exit. That'll be for a small loss. Get out when you've achieved 50% of your maximum ROI. And then last exit rule is get out 2 days before expiration. Simple. All right, I got a case study for you. This is on Barrick Gold. Here's the trade. The stock symbol is GOLD. We're going to sell one GOLD August 28, 30 put. We're going to buy one of the September 18, 30 put. That's going to cost us $60 per contract. Again, that's our maximum risk. $76.96, $77, let's call it maximum profit for a potential return on investment of 128.26%. Again, we're going to get out for half of that, which will be 64% profit would take this position off. And for every calendar spread you buy, you're going to get $2.28 a day of Theta sunshine. Of course, if you did 10 contracts, you'd end up spending $600, and your positive Theta would be $22.80 a day. And again, that number gets higher and higher as you approach expiration. Let's take a look at the risk graph. Well, notice today that Barrick Gold actually gapped up. Why did that happen? Warren Buffett bought some stock. Warren Buffett gave Barrick Gold the nod, and the stock gapped up. It gapped up above 28 resistance. Look at this line here at 28. Our lower break even is right at 28, just above, but 28 resistance right there, 28 resistance there. Now it's support, so I've got a nice support level to the downside, and we've got some resistance right up here at 32 as well. So we'll see what happens in the stock. The only danger in this trade is that the stock gets really bullish. We'll see what happens. I think that's a big gap up, and most likely we're going to see some sideways movement at least over the next 11 days. This is a very short-term trade and an excellent probability proposition. And if you haven't traded calendar spreads and intend to trade them for real, I'd also recommend doing a lot of back testing just to make sure you understand the ins and outs of the wonderful world of calendar spreads. All right, I hope you enjoyed that video. Have fun with calendars. Have fun making money as the sun rises, and I'll see you next time.